Your bank balance is not what you think. That number on your phone is not a pile of cash waiting inside a vault. It is a promise from a bank. And here is the shocking part. Most of the money in the world was not printed by a government machine. It was created when someone borrowed. A mortgage, a credit card, a business loan, a car payment. Every time banks create loans, new money can appear on a screen. And when those loans are repaid, some of that money disappears. So the real money machine is not the printer. It is the bank loan. Before we go inside this machine, subscribe to the channel. Because once you understand how banks really work, you will never look at your bank account the same way again. Most of the money we use today is just numbers on a screen. And here is the part most people are never taught. Banks do not only move money, banks create money. When most people imagine a bank, they think it works like this. One person deposits money. The bank keeps some of it. Then the bank lends the rest to someone else. Simple, right? But modern banking does not work that way. According to the Bank of England, most money in the modern economy is created when commercial banks make loans. Not before the loan, at the moment of the loan. Imagine you walk into a bank and ask for a $100,000 mortgage. If the bank approves you, it does not usually take someone else's $100,000 and hand it to you. Instead, it creates a new asset on its balance sheet, your loan. And at the same time, it creates a new liability, a deposit in your account. Suddenly, your account shows $100,000. New money has entered the economy. That is the first shocking truth. Loans create deposits, not the other way around. This is why banking is one of the most powerful businesses in the world. Because a normal company must earn money before it can spend or lend it. But a licensed bank can create deposit money by issuing credit. Now, while this does not mean banks can create unlimited money, that part is important. Banks are limited by rules, capital requirements, credit risk, customer demand, competition, and central bank interest rates. If they lend too recklessly, borrowers may default. If people lose trust, deposits can leave. If the bank does not have enough capital, regulators can stop it. So the system is powerful, but fragile. Here's the second shocking truth. When you repay the loan, the money can disappear. If a bank creates money when it makes a loan, then repayment destroys that money. The principal payment reduces your bank deposit and reduces the loan asset. So money is born as debt, and part of it dies when debt is repaid. But interest is different. The interest you pay becomes income for the bank. That is one major way banks make money. They charge borrowers more interest than they pay depositors. This difference is called the interest spread, or net interest income. So the bank creates the loan, receives repayments, collects interest, and manages risk. That is the machine. But there is another layer. Your bank deposit is money to you. You can buy food with it, pay rent with it, send it to a friend. But to the bank, your deposit is a liability. It is money the bank owes you. That means the number in your account is not a pile of cash. It is a promise from the bank to pay you when you ask. And this is why trust is everything. If one person asks for cash, no problem. If many people ask at the same time, the bank may not have enough liquid money ready. That is called a bank run. This is why countries created deposit insurance and central banks. In the United States, FDIC insurance protects deposits up to $250,000 per depositor, per insured bank. In the European Union, deposit protection is generally harmonized at 100,000 euros. These systems exist because banking depends on confidence. Without confidence, even a strong-looking bank can face panic. Now here's the third shocking truth. Central banks do not control money, the way many textbooks used to explain. Old textbooks often teach the money multiplier story. Central bank creates reserves. Banks multiply those reserves into loans. Money supply expands mechanically. But modern central banks and researchers say, this simple model is outdated. In reality, banks lend when they find profitable, credit-worthy borrowers. Then they manage reserves and settlement afterward. The central bank influences the process mainly through interest rates, regulation, liquidity support, and monetary policy. So the economy is not powered by cash. It is powered by credit. Your mortgage, your credit card, your business loan, your car loan, these are not just personal debts. They are part of how money enters the system. That is why debt growth can feel good at first. More loans mean more spending. More spending means more business revenue. More revenue can mean more jobs. But too much bad debt creates danger. Because if many borrowers cannot repay, the same system that created money can destroy confidence. Loans stop, spending falls, banks tighten, people panic. That is how financial crises begin. This is why the real secret of banking is not that banks are evil. The real secret is that banks are trusted with one of the most powerful tools in society, the power to create money through debt. And most people use banks every day without understanding the machine behind the screen. So the next time you open your banking app and see a balance, remember, that number is not just money. It is trust. It is debt. It is accounting. It is regulation. It is confidence. And if trust breaks, the whole system shakes. So subscribe for more money stories that schools never explained clearly. Because the world of finance is not boring. It is hidden in plain sight.